Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, October 29th. The technology stocks got a fresh energy boost as Nvidia CEO Jensen Huang threw in fresh deals with companies around the world to cement its dominance and ensure its expansion beyond the US borders yesterday. Today, a rate cut from the Federal Reserve and maybe the announcement of the end of the quantitative tightening could further boost appetite in risky assets. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. Who needs data when Nvidia is out announcing fresh deals, right? The company's CEO Jensen Huang at yesterday's GTC conference revealed fresh deals with Nokia, Palantir, Uber, and the US Department of Energy. So quickly speaking, Nvidia will be teaming up with the Department of Energy of the United States to build 7 AI supercomputers. That means a lot of chips to be sold to the US government. Then, they plan now to invest $1 billion in Nokia to turn the Finnish mobile networking giant that's still alive, yes, into an AI-led company. Of course, Nokia will be using Nvidia's chips to accelerate a software for 5 and 6G, while Nvidia will be exploring how it could use Nokia's data center strategy and infrastructure in its business. Again, there is some circularity here, but also real revenue potential and outlook for both companies. So Nokia shares jumped 24% to the highest level since 2010 yesterday on the news. Then, Nvidia will be working with Palantir for government and industry applications and customizable AI agents. Nvidia also reportedly already booked, are you sitting? I hope you're sitting, because they said that they already booked $500 billion worth of Blackwell and Ribbon chip sales for 2025 and 2026. And it will be announcing deals apparently with South Korean companies, including Samsung and Hyundai later this week. So no wonder Jensen Huang doesn't see any bubble out there. So Nvidia's shares soared 5% yesterday, past the $200 per share psychological level, and that for the very first time in history. And S&P 500 timidly advanced to a fresh all-time high level, led by technology, while Nasdaq 100 index printed a comfortable 0.74% advance to a fresh record high as well, also pumped by a 2% jump in Microsoft that on its end will be receiving a 27% ownership stake from OpenAI, positioning the latter on track for becoming a for-profit company. So overall, you heard it. Move on. There is no bubble to be seen here. And Microsoft, Meta, and Alphabet will be revealing their third quarter earnings today after the bell. Now, at the current price levels and valuations, these companies can hardly make any missteps, both on their numbers, on their spending plans, and on their guidance. But it's been since more than a year now that skepticals are walking into the big technology earnings, betting on a broad sell-off as AI revenues don't grow fast enough to follow the level of huge investments. So it's a sure thing that will happen one day. I mean, that will happen one day, but it's been 3 years that the big technology earnings meet and beat expectations. And hearing the deals and the numbers that are enrolled in these huge deals are announced these days was hard to swim against this AI tide, at least for Nvidia, because whether AI investments elsewhere generate revenue or they do not, the big technology companies have ample cash in hand to spend on these chips, and they are spending. Now, one little thing though, ASM International's third quarter orders miss expectations on lower demand from clients, including big names like TSMC, Intel, and Samsung. But will it discourage the AI bulls from buying more? Hardly, I would say. hardly given the level of news that we hear today. So of course, the AI needs energy, and nuclear has emerged as a type of clean energy that could satisfy these huge energy demands from these companies, as you can't rely on solar and wind energy to power all these machines 24/7. As such, the big technology companies and the US government are now out, as you know, announcing nuclear deals every other day as well. So the global ex-uranium ETF was up by another 8% at yesterday's trading session, and the ETF reached the highest level since 2011. This parabolic move echoes what we see in AI and technology's hunger for energy moving forward. Simply. Now, this is all pretty much it for the technology news and their energy demand. If anything, well, yesterday's move could still get a little bit of sugar coating today if the Federal Reserve sounds sufficiently dovish later when they announce their latest monetary policy decision. In the absence of fresh data from the US, the Fed is clearly asked to act half-blinded, obviously, but is widely expected to announce a 25 basis point cut today, and maybe even the end of the quantitative tightening, as the extra liquidity pumped into the market since the pandemic months has fully melted now. Some big bank analysts even think that the Fed will announce an immediate end to the quantitative tightening as soon as today. That would obviously be so good for the market move, because the ampler the liquidity in the market, the more capital is available for the market to invest in risky assets. And there is nearly $7.5 trillion parked in the US money market funds today, which will, with lower interest rates and lower yields, be encouraged to seek return in the riskier pockets of the market as well. So the market has room to run hotter, believe it or not. And in the FX, the US dollar remains under pressure, though it's again better a bit in Asia this morning. A dovish announcement from the Fed could further pressure the greenback against the major currencies, but the downside potential in the greenback remains limited, and that's limited due to the unwillingness of investors to add on three major currencies at the moment as well. One, there is quite little appetite for the Japanese yen today, because Takaichi's is now pushing for a softer Bank of Japan policy, and that will be negative for the Japanese yen, and the dollar yen could actually advance toward the 155 to 160 range for the end of this year rather than the contrary. Two, there is low appetite for the euro, because the French shenanigans occupy the headlines with the possibility of another government collapse in France sooner rather than later. So that possibility is obviously weighing heavier than stability in French politics. And three, there is little appetite for sterling before the upcoming autumn budget. Plus, the latest inflation report from the BRC yesterday revealed the largest drop in food prices in the UK in October in nearly 5 years. And that was mostly due to a significant retreat in sugar prices, but it clearly boosted the Bank of England dollars yesterday. So, the fact that the US dollar stopped depreciating recently when the US government remains shut and there is no end to this US government shutdown is more due to this unappetizing other major currencies than a better appetite for the greenback. But a dovish statement from the Federal Reserve today could eventually change that and add some more pressure on the US dollar. But note that really major peers, if that happens, will probably remain limited, and potential price rallies could eventually serve as opportunity to sell the majors against the US dollar, because the US dollar is already deeply sold this year, and because the dovish Fed expectations are to some extent already priced in. Now the question is, will all that lack of appetite for traditional currencies throw a floor under the gold's recent drop? Well, possibly into the $3,800 per ounce level that is just a touch above the minor 23.6% Fibonacci retracement on the past 2 years gold rally. So I will leave it here today and let Jerome Powell and the earnings from big technology companies do the rest of the talking for the day. So I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.